Stop dreaming about buying the dip. Global liquidity drainage may have already begun. Before you jump back into the market, you need to ask yourself one thing. What if the real force pushing your portfolio down isn't your stock choice, isn't earnings, and isn't the economy? What if the real force is coming from Japan? Yes, Japan. And specifically, the rising expectations that the Bank of Japan may raise interest rates for the first time in a long while. That single policy shift has the power to shake the entire global financial system because it threatens one of the biggest and least understood engines of global liquidity, the yen carry trade. For years, the yen has been the world's cheapest funding currency. Near zero interest rates allowed investors everywhere to borrow yen almost for free and convert it into dollars or other currencies and pour that money into higher yielding or higher growth assets. Tech stocks, crypto, emerging markets, high yield debt, you name it. If you ever wonder why global markets could stay inflated even when fundamentals were questionable, this is one of the hidden reasons. Ultra-cheap yen funding, a tsunami of liquidity that lifted valuations around the world. But here is the problem. That entire structure depends on one assumption. The yen must stay cheap. The cost of borrowing yen must stay low. And that assumption is now breaking, with Japanese government bond yields hitting multi-decade highs and markets pricing in a potential rate hike by the BOJ. The carry trade is under pressure. Borrowing yen suddenly becomes more expensive. A rising yen makes outstanding carry positions even more painful. And when a carry trade becomes unprofitable, there is only one thing investors can do. They unwind. They sell assets, they close positions, they exchange back into yen, and that forced selling does not happen because assets are bad. It happens because liquidity is reversing. This is the part most people never see. It is not fear driving the selling, it is math. It's margin. It is funding costs. And when trillions of dollars of positions unwind at the same time, it can trigger what some call a global liquidity drain. High-valuation assets tend to get hit the hardest because they rely the most on cheap liquidity to justify their prices. When liquidity tightens, valuations compress, not because the company suddenly changed, but because the world's funding conditions changed. This is why this moment may not be the noise. It may be a historic turning point. For over a decade, global markets enjoyed a liquidity tailwind supported partly by the yen carry trade. If that tailwind becomes a headwind, markets will feel it everywhere. This does not mean markets crash. It does not mean panic, but it does mean the playbook that worked in the past decade may not work in the next one. In a liquidity tightening cycle, price action becomes more sensitive, volatility increases, and investors need to understand the difference between a market driven by fundamentals and a market driven by liquidity flows. So, if you take one thing from this video, let it be this. Markets do not move only because of stories or earnings or hype. Markets move because liquidity moves. When liquidity expands, everything floats. When liquidity contracts, everything gets heavier. If it feels like the market has changed, it is because the liquidity cycle has changed. Thank you for watching. If you want more clearer macro explanations without the jargon, make sure to subscribe. Understanding liquidity may be one of the most important financial skills over the next decade. We'll see you in my next video. Thank you.